Hello, everyone, and welcome to another installment of John and Jane's retirement series. In this case, it's for John's August retirement account review. After this one, I will be getting to work on the ones for September and hopefully have those done right about the time that we get into November so that these reviews will be basically exactly right after the end of the month instead of 60 days afterwards. It'll be 30 days. So that is my goal moving forward. But without further ado, let's move forward. As always, I am not a financial advisor. I don't claim to be one. This or this video reflects my personal views, and I'm not giving any specific or general advice. This article is written on my own and does not reflect the view of my employer or the opinion of my employer. I do share some similar positions with John and Jane. Those are listed on here. These are the ones that specifically match what John has in his portfolio. And it is a real portfolio with actual shares being traded. It is not a practice portfolio, which is why I include screenshots to demonstrate the things that actually happen during the time period that we're reviewing in this account. For John and Jane, again, relationship goes back quite a few years, and their financial advisor was doing some things that were not in their benefit. And after talking with John and Jane, decided to make the switch to having them basically manage it on their own and just assist them with the process. And I think that the key takeaway on this is that challenge the conventional thinking, take control of your investments if that's something that you want to do. I do not get compensated by John and Jane, and really my only goal or the only thing I asked of them was at the time that they allowed me to write about it, which I did on Seeking Alpha. And Seeking Alpha decided that they did not want to continue publishing my series after 6+ years, or almost 6 years, I should say, of doing it. So that's kind of how we got to where we are today. And so for our background, John retired in 2018 and Jane retired in 2021. They collect Social Security, and from John and Jane's taxable account, they collect $1,700 a month, with another $1,000 a month from John's traditional IRA. Outside of what I help them with, they do have investments that are primarily in low-risk bonds and certificates, which are held typically at brick-and-mortar financial institutions. And then John and Jane have no debt or monthly payments other than basic recurring bills, such as water, utilities, things like that. And the traditional IRA in the month of August generated 1,127 of dividend and interest income compared to 887 dividend and interest income in August of 2022. So that was a pretty substantial increase. The Roth IRA generated 578 in August of 2023 compared to 532 in August of 2022. So a slight increase there. The traditional IRA had a balance of just under $340,000 at the end of August of 2023, and that compares with just shy of $359,000 in August of 2022. One thing I'll point out with that is that since we do take the $1,000 a month from John's traditional IRA, if we were to add back in the $12,000 that has been withdrawn during that time, we would see that the balances would be quite a bit more comparable, only off by about $6,000, $7,000 approximately. And then the Roth IRA had a balance of $208,000 at the end of August 2023, which was about $6,500 shy of the $214.5 that it was at the end of August of 2022. So one company in John's retirement portfolio paid an increased dividend or a special dividend during the month of August, and no companies decreased their dividend payouts during that time. The company that increased the dividend was Lowe's, and that was 4.8% dividend increase, which is on the light side for what we've seen them do previously, but is still pretty reasonable. I definitely don't have any issues with that increase. And for Lowe's, we've been seeing the slide in the stock price happening over the last few weeks, and really actually, yeah, I would say it's over the last few weeks, maybe even the last month at the most. It's been sliding off of its 52-week highs, and actually, as of the time that I'm making this video, the limit trade would have executed for $190 a share, which will double the size of the existing position from $20 a share, 20 shares to 40 shares. So Lowe's is a position that we've traded in and out of before, and that's 190s I've found to be a pretty good buying point. Yeah. So the current position of Lowe's, the cost per share was $190. So with the addition of the new 20 shares, it's still going to be at $190 a share. And at the time that this screenshot was taken, as you can see, that price was actually quite a bit higher. So Lowe's in the last few days has actually dropped just about $10 a share, making it, again, quite a bit more attractive. But yeah. And then as far as August goes, the traditional IRA, there was a number of buys with one sell in the traditional IRA. We went ahead and added some probably a little bit prematurely with Realty Income. That was just 25 shares. But we added a chunk more of healthcare realty. And I know that I typically talk about buying in small tranches. And in this case, when we start getting down into, share prices, I'd say especially under about $20, that's when I typically start buying in a little bit larger tranches, just due to the amount of money that's involved. Because in this case, you can see for 100 shares, for example, of healthcare realty, we're talking about just over $300 more than 25 shares of Realty Income would have cost. So again, the goal is mostly just to keep it kind of proportional or within reason, in terms of how much we're adding based on dollar amount. And like I said, specifically when you start getting into the lower dollar shares or lower share prices, under $20 a share, that's the reason why I bought a little bit bigger piece there. And then as far as Avista goes, you can see where we added a couple different times there. Avista is our local utility where I live in the Pacific Northwest. And even though we see it going down more, in fact, actually, as of today, we're down close to about $31 a share. But utilities right now are part of performing poorly, and a lot of that has to do with interest rates and long-term yields. So then the only sale that we had was for Toronto Dominion. This goes back to what I've said about reducing exposure to Canadian banks, and the key here is just that I just don't like the way that their mortgage situation is, the lack of affordability. I don't see an upside with Canadian banks at this point in time. And as of the time that this video was made, that share price has since dropped down another $8 a share roughly. I'm not going to say that it was the greatest sale in the world, but mostly it was just to add capital back to the reserves, so that we can use it to invest in other opportunities. And then as far as Columbia banking system goes, so that's going to be the merger between Umpqua and Columbia Bank. So they retained the name Umpqua in terms of the name that they advertise or they show to the public, but everything now went from the ticker symbol UMPQ to COLB. So now the merger of the two has made an extremely one of the largest banks in the United States. I can't remember right off the top of my head, but I think it's in the top 25 now, if I remember correctly. Whereas before it was closer, Umpqua itself was about, it was in the top 100, but it was definitely on the higher end of that, because I think it was a little right around $50 billion or so in assets. So Umpqua Bank used to be my employer. That would be going on about 4.5 years ago. And it was a good place to work. The thing I like about the merger of the two companies is that Umpqua was heavily focused on the mortgage side of things. They did a lot of construction loans, a lot of private portfolio arms, things like that. That's kind of where the department that I operated in with the mortgage-backed securities, and the addition of Columbia Banking, and merging those two portfolios together, is that Columbia Banking is heavily focused on business lending. So this kind of balances out. Both companies gave Columbia more of a real estate, residential real estate focus, while making Umpqua now more heavily focused on the business side of things. They share a similar footprint, so it did make sense for the two companies to merge together, and so we decided to add additional shares just based on where the stock price was at that point in time. Obviously, like most things, it's been continuing to drop since then. We might consider adding a little bit more here in the near future, but we're more than happy to wait and see a little bit more into buying smaller tranches. And then as far as the August trades for the Roth IRA, you can see that there was 2 purchases there, and when it came to this, it was just the addition of more shares of UTF. And with UTF, you can see that the share price since then has dropped tremendously. So we're now sitting at about $18.50 a share, compared to where it was here. And that's going to be something that the yield right now is pushing darn near 10%. And so it is a buying opportunity, I think. And this UTF does have more leverage in it than its competitor UTG, or I shouldn't even say competitor UTG, but UTG, it just is similar, but it has less leverage. So in this case, because it's with the utility sector, I'm pretty comfortable with UTF and the performance that we've seen from it. So for August, in the traditional IRA with the realized gains, because it was only Toronto Dominion that was sold, you can see that there is a small realized gain that was associated with that. Really not much else to see there. So basically we were still, again, like always, we sell the highest cost portion of the shares. So anything that we have remaining in Toronto Dominion is now at a lower cost basis than what it was prior to this sale. So we never sell the shares that are at the lowest cost basis, or at least I will specifically say if that's something that we do, but it's just not something part of the strategy that we use. And then for the Roth IRA, nothing was sold, so there was no realized gains during the month of August. And so year to date, when we look at the traditional and the Roth, we can see that the total proceeds and the total cost basis. So for the traditional IRA, we have seen quite a bit more in proceeds than we've seen from the Roth, which makes sense because there's quite a bit more capital that's held in the traditional IRA. As far as the investments that John has, we haven't sold as much as the ones that you might have seen with Jane's account. And the big reason for that is that a lot of what John is invested in is income producing assets, whereas with Jane's, we were selling off shares of like Broadcom, for example, AVGO, And so others that are more of low yield growth type assets, whereas John's assets, because he's been retired for longer, has been more targeted at income producing investments. And so that's part of the reason why you've just seen less sale activity with his traditional IRA as compared to Jane's. And again, same thing for the Roth IRA as well. Now for the year-over-year review of these, basically we eliminated Masco from the portfolio. Main reason on that was going to be that I think that, Masco was riding the home renovation wave and kind of the benefiting from that boom. And so I see, sales pulling back. I see their earnings, pulling back. And so I wouldn't say it's a bad investment by any stretch of the imagination. I just didn't see much upside left for it. And it was one of the investments that we just said it would be better just to have the funds back in the portfolio or sitting as cash in order to, reinvest at a different point in time. And then the position for OzCap, that is the preferred shares for Bank OZK, and we increased that pretty substantially. One of the things that I like about OzCap is going to be that their dividend for the common shares is continuing to grow, but also that it's pretty well covered. So even though we're getting into an environment where banks are going to be experiencing higher losses and their earnings are going to be taking a hit, their preferred shares their payments are pretty well insulated, and also there's the potential for the capital gains on the back end. So, and then the decrease here, and remember this decrease did not happen in the month of August, but PacWest Bank Corp cut its dividend significantly, and if I remember right, the reason why we're kind of holding on and just waiting to see what happens is that we are waiting to get the final regulatory okay for the merger with Bank of California, and I think that should be coming pretty soon. We'll see what happens with that. I mean, I can't imagine them saying no to it. And then for the Roth IRA, we've seen that the Apple Hospitality dividend has continued to grow after it was reduced significantly in the aftermath of COVID during 2020. So that's producing significantly more income than it was at the same time in 2022. And then for Eaton Vance's EAFAX, so position has remained the same size the entire time that we've helped with the portfolio, but it just goes to show how much the rising rates, because that fund is tied to bank loans, variable rate bank loans, but how much rising interest rates have increased the dividend payouts associated with that. And then we recently eliminated Rhythm Capital preferred Series B from the portfolio, mostly in this case. And that distracted me here. So the income was collected under shares no longer held, which can be seen right here, but previously you could see it right here. And it's not that Rhythm Capital is necessarily bad. It was just, again, I see it as a better move to have those funds sitting on the sidelines, because it was a pretty minimal loss, or it might have even been a small gain that we sold it for. And for the year-over-year comparison, you can see here, yes, we're reducing the holdings and pushing money towards safer investments. Dividend growth will moderate, and there's actually a high probability that we'll see income temporarily pull back especially depending on CDs and when they pay out. I typically focus on CDs that pay monthly, even if there's a small sacrifice in yield, just to simplify and to not create large incomes for ones that maybe only pay like if it's like a 6-month CD, maybe it's just at its maturity date. I don't necessarily want a huge income coming in, of several $100 over the course of 6 months, collecting it in 1 month. So I do try to get it to where it's spread out, and it's pretty easy to find CDs like that. And again, the interest rate or the yield is not that much different than ones that pay at maturity. And I'm a big fan of collect my cash now, so it fits with that strategy. But I would say that the biggest factor here is going to be how much of that cash that is going into their account, how much of it is being collected and just sitting there, or how much of it is being put into CDs. That is going to have a huge impact on the income that is being produced. So be prepared to see these numbers, kind of fluctuate a little bit. And it's going to, again, depend on which investments get sold. Some investments that have really low yields and replace them with, 5% yielding CDs might actually see a benefit. But on the other hand, selling off shares like Rhythm Capital's preferred Series B, that was yielding, I think, somewhere in the neighborhood of like 11%. So be prepared to see that income, even if we did add a CD, that income is going to have gone down. It's just going to be on a case-by-case basis. And then for the account balance comparison, account balances had decreased slightly in the end of August. It's decreased quite a bit more than that in the last couple of weeks, and that goes back to the whole reason why I'm trying to get caught up with these articles, so that it's a 30-day look back rather than potentially 30 to 60-day look back. Trying to make sure that it's as timely as possible when reviewing these, so that I'm giving the most recent and updated information possible. And as mentioned previously, if we added back in the $12,000 of cash withdrawals, the balance is only about $7,000 less than what it would have been if those withdrawals had not been taken. So on our 6-year look back for the traditional IRA, we can see that right now we're projected to have the first decrease in interest and dividend income. Now with this very large special dividend that was collected here with the merger of Healthcare Trust of America and Healthcare Realty, that was a one-time event that boosted the income. If we removed this, we would be sitting at a positive dividend income increase, and I will go ahead and do the math on that as we get closer to the end of the year. I'll look up what those numbers were, and I'll add that to the side here just as a caveat, because I do think that that's important to point out, that it's not like the dividend income truly decreased necessarily. It was for an actual reason why that happened. And then for the Roth IRA, we can see that in John's account, COVID hit pretty hard here. So that's where we can see that the negative impact was had. But we've seen, and I don't count 2018 because there was a lot of volatility there. But we can see here where still from 2019 to 2020 was a pretty substantial drop. But then it was a pretty substantial increase in the month of August, and has steadily increased since then. Now for the cash balance comparison, you can see that the cash balances in both accounts have pushed back up to their highs for 2023, and are typically at higher levels than what was seen in 2022, which was an environment where we held fairly little cash, or at least focused less on holding cash. But these do not reflect investments in CDs and money markets. And John currently has $30,000 in CDs and approximately $53,000 in cash on the sidelines. So we're talking about $83,000 of liquid investments, and that was as of October 17th. And then for the unrealized gain loss comparison, you can see where it slipped back into the negative here. For the gain loss, unrealized gain loss piece of it, it's not something that bothers me. I probably cannot repeat it enough. That for me, the biggest thing is that investing in stocks and having holdings that go into the negative shouldn't concern you, and if it does, then that's probably something where you need to revisit your comfort with that stock or with that company and why you're holding it. So the goal should be to try and hold things that are as high of quality as possible, so that when the market does shift or there are swings, kind of like what we're seeing right now, that it going into the negative does not cause you to panic sell. The only time we're typically selling at a loss is when we see another investment that's better, which is, I would say, probably not terribly common, or the investment thesis around that stock is not looking good, and we're basically cutting our losses at that point in time. So, but it does make sense why we see the with the gains being taken off the table as well too, from the shares that have been sold, why we're also seeing it moving towards the negative here, because basically we have taken some of these gains off the table, and that was shown on a previous slide. So for the traditional IRA and the withdrawals, John is continuing to take out $1,000 a month, and even though the account generates about $1,370 a month, John and Jane have decided that they're still comfortable with the $1,000 a month, but they could take $1,370 a month based on the current numbers, and basically be cash flow neutral at worst. So that's kind of the idea behind the dividend and interest income, is that $1,370 a month is what allows this consistency right here, even though we're seeing a lot of volatility in the market. For the traditional IRA, the current gain losses, I always say that this is the most important table to me, and the reason why is because I can't fake it. Okay, I can't take these numbers and manipulate them in a way that makes it look like the portfolio is performing better than it did. I try to always show when there's unrealized gains, there's unrealized losses, but in this case, when you see people talking about their investments and how they make all this money, I would say that the biggest thing that needs to be understood is that there is going to be volatility, okay? And the people that don't talk about volatility are the ones that drove me to want to make these videos in the first place, because the idea is that you can see here there's a lot of volatility, and you need to be willing to accept that volatility. And if you're going with the dividend and interest type investment model, this volatility shouldn't matter to you as long as you're comfortable with the holdings that you have over here. So as long as these holdings continue to generate income, then John and Jane can continue to live comfortably, and they really shouldn't have to care. Now, the only exception is going to be is on the traditional IRA. John is reaching the age where the government is going to require him to start taking draws from his account, but that is part of the reason why we have so much cash on hand, because with John's account, not only is it generating plenty of dividend and interest income to cover his withdrawals, but also his required minimum distribution, so RMD, is less than the amount of income that's being generated on the account, and my goal is to make that last as long as possible so that he never has to sell shares, or at least shouldn't have to sell shares in order to pay for something like that. And then for the Roth IRA, same exact kind of scenario here, where again, showing the volatility that's associated with it. And as long as you're comfortable with these here now, the one that catches my eye right off the bat is Sun Communities, right? So Sun Communities has a dividend yield that's going to be, I would say, given the rate environment that we're in, on the low side. And right now it's about 3.5%. But the idea is that even if it is low, even if it is causing the with rates being where they're at, is pushing that stock price lower. As long as Sun Communities can continue paying that dividend and wants to, make, annual raises on it, that's the part that matters the most to me, because even if that yield isn't as high as we'd like it to be, we can tolerate it, in the short or medium term, to make sure that John and Jane have the income that they need. And that's going to be something that's driven by the rate environment, just a multitude of factors. But yeah, these investments that are underwater, as long as they are producing income, that is the part that matters the most. And again, I'm not saying that it is ideal to have something be underwater. It's just that you have to learn to accept that volatility in exchange for the lack of volatility of us not having to sell these shares in order to fund, their retirement. So, very similar to the previous article's conclusions, expect to see cash balances increase, CDs increase, the current gain loss tables that you saw in the previous two slides, those were made in October. So because of the timing difference in these articles and the part that I'm getting them caught up on, I just want to point out that those gain loss ones are showing where the portfolio is as of the time that this video was made, and doesn't match with the numbers of the end of August, which is where all of the previous screenshots to that were from. So just a reminder that tax deferred accounts, so traditionals, IRAs and Roth IRAs, have no impact on the taxable income. And that is part of the reason why we're more willing to sell from the traditional and Roth IRAs as compared to the taxable account, which the taxable account would cause either a gain or a loss, depending on whether or not that position was sitting at a loss or a gain. I think that the continuing resolution with the U.S. government and the debt is set to only cover funding through November 17th. So I expect to see a lot more volatility as we get closer to that date. Sure enough, in the last week, I feel like we've been seeing nothing but increased volatility, especially as long-term interest rates just continue to get more bleak. And so I think that that's going to be a defining event here as we get into November, that investors need to be aware of and be considerate of. So I appreciate everyone taking the time to listen and watch this video. As always, I'm doing my best to try and make them as short as possible. I'm also in the future going to probably look at making it to where we do some video editing and things like that. So thank you everyone who has taken the time to watch these through. And even if you're just, rolling through to see the screenshots and things like that, I think it was in a previous video that it gave me the idea of uploading the slides. Because if there's folks that would just rather, download the slide deck, I'll see if I can upload that to YouTube. I am definitely by no means a YouTube expert. So I'm going to see if I can do things like that. If that is a better resource and you guys don't have to listen to me necessarily the entire time, I'm more than happy to do that, because I care more about the information getting out there than you guys having to listen to my wonderful voice and rambling that I'm sure I do regularly. So again, thanks everyone. Really appreciate your time and you watching. Let me know in the comments if there's anything that I can do differently to make these more useful, and we'll see you on the next article or the next video.